Hello, everybody. Welcome to Kinship Case Study Conservation number 7. Ricardo, Logan, it's great to see you again. I'll pass immediately on. My name is Nigel Asquith. I'm a director of the Kinship Conservation Fellows Program. Without further ado, I'll pass it on to Ricardo. Good to see you both.
Thank you, Nigel, and thank you everyone for joining us on this 7th pilot case studies in conservation. What we do here is we try to look at different approaches to conservation and conservation finance, try to understand how they've worked, not worked, look at a variety of case studies, and maybe even look at sort of new approaches to conservation that could have promise in conservation finance. Today we have a treat. We have Logan Yonavjak, and I always mispronounce her name, so Logan will tell us exactly how to say her name, who I've known for, gosh, I want to say it's way over a decade now, right, Logan?
I think so.
And who was also a Kinship Fellow. And she's been working on a number of different really interesting initiatives, and is part of a new group that was set up, I think largely here in the Bay Area, right, Logan? To work with conservation finance on a number of different groups. And as you will have seen from the announcement we put out, what I find interesting about the work that Logan's been doing is that, you know, it kind of brings and melds a variety of disciplines together, right? One is finance and one is conservation. And I remember when I started in this space, it was hard to find people who understood both. So what we ended up having to do when I created a group called Eco Asset Management Partners is we would hire an expert in finance and we would hire an expert in conservation, and we would have them work as a team. I think the world has changed in that intervening time since that happened. And what we've seen is a lot more people like Logan out there who understand both sides of the equation, who understand conservation, who understand finance. And I think it comes as well from having new programs at major universities, whether it's Duke or Yale or Stanford or whatever, that kind of try to train people in both those disciplines and try to look at the overlap. And I think the work that Logan's been doing recently, I find extremely interesting because it's trying to work both with conservation organizations as well as with businesses to bring that kind of overlap and overlap thinking. So maybe Logan, I can let you introduce yourselves, and you can give us a sense of the work you've done over the years, and then we'll start delving into some of the examples you've worked on. I should say that for those of you who haven't been on one of these before, the way we handle questions is you type in your questions into the question box. We take a look at them, and when we get into the question and answer section, which should be within the next 40-45 minutes, I will call on you and we will unmute you, and you can ask your question and ask any follow-up. So remember, as we go along, feel free to type in your questions in the box on the right or wherever you've got that little box on your screen. So Logan, without further ado, maybe just a few words about your background and your time at Kinship, and then what you're doing now.
Great, thanks so much, Ricardo. And I just wanted to give a shout out to Ricardo as well. And when I was earlier in my career kind of exploring the intersection between conservation and finance, you're one of the first people I met who was actually doing this work at Eco Asset Management Partners. And so one of the first kind of people I ran into, professionals that I looked up to and was excited to get to know. So it's fun to be here today.
Everywhere, Logan. Glad to get you everywhere.
But yeah, so early on in my career, I was studying land conservation at UNC Chapel Hill, had grown up in the Triangle region of North Carolina, and was witnessing a lot of sprawl development. And my central question kind of throughout my career was, why does it make more economic sense to build more strip malls and take away more open space and working lands, as opposed to leaving them as open space and working lands? So that's kind of the central driving question that I had. I started my career at the World Resources Institute in Washington, D.C., an environmental think tank that was looking at environmental and natural resource questions from a variety of different angles, writing a lot of research reports, looking at policy. But I found that when I was there, a lot of the professionals on staff, there are a lot of great minds, but there wasn't necessarily enough business or financial acumen to really, I felt, get to scale on some of the problems that we were facing. So I decided, literally those words came to my mind, I want to be someone who bridges the gap between the finance world and the conservation world. So the next step that was illuminated to me by various conversations with people in the space was to go to Yale and do this dual degree, to get an MBA and to get a master's in forestry is what I ended up choosing. But also in my entrance essays, I was talking about this desire to bridge the gap. So, you know, that's kind of been the two skill sets I've been building throughout my career in parallel and interweaving through various experiences I've had. And when I was in business school, my primary priority was to continue building out my understanding of natural resource management, but to really get as much experience on investment teams and working on investment processes and diligence as much as I could. So I spent some time at the Yale Investments Office and also a wetland mitigation banking group that was doing wetland deals on the ground in the US. So those were sort of my two summer experiences. And right before, I should mention this, right before Yale, I was a Kinship Fellow, which was great in the sense that I was taking a project, I was actually working on a finance instrument called the Conservation Investment Note. And what the Kinship Fellowship enabled me to do is really dive deep on that instrument over the course of 6 weeks in Bellingham, Washington, with a number of other conservation professionals, and really kind of iterate on that mechanism. So it really helped me advance my thinking around the tool and what we were developing. And also just a great time with wonderful people from around the world thinking about conservation issues. So yeah, anyway, after graduating from Yale, I spent a stint at Morgan Stanley in their sustainable investing group. Decided it was not quite the right fit for me, a bit too big and a bit too clunky for the innovation I wanted to achieve, but found my way to CREO Syndicate, which is a family office network, which really brings together family offices in the US and now Europe who really care about environmental finance. And so I screened hundreds of companies and funds for that network and really tried to better understand pathways to investing in impact, like water. You know, there were a lot of food and ag, fisheries, so a lot of different thematic areas that families were starting to get interested in deploying capital into. We both looked at direct deals and funds, but we also thought strategically about the bigger picture and how to actually develop roadmaps for these investors. And then kind of fast forward to today, I did a little bit of independent consulting in between jobs, and then I founded Provenance Capital Group, which I'm thrilled to share with you today because in many ways it's the culmination of a lot of what I've been developing in my career and thinking about in my career. And I can bring up some slides now, a few slides to show you, but essentially what we're building is a marketplace to connect investors and enterprises and funds in food and ag. So we are, you know, the team that formed around this, my business partners and I, really felt that there were more and more deals coming out, more and more interesting funds getting launched, a lot of investors expressing interest, but no one really kind of professionalizing the financial infrastructure. Like many groups are kind of trying it at different angles, but the broker dealer space is kind of lacking that concerted kind of focus from professionals who've been, you know, two of my teammates were on Wall Street for the majority of their early careers and kind of building out that acumen from the mainstream space and bringing it to impact. I've sort of kind of always been an impact, and our fourth business partner comes from manufacturing and sold his own company a couple of years ago. So had kind of was looking for the next thing to do, and also has experience in regenerative ag. So we kind of brought all of our forces together.
There's so much to unpack there. I mean, your background, where you came from, the work at Yale, the conservation innovation notes, and now this Provenance Group. Just for people who might not be familiar with the term broker-dealer, which is, a regulated term here in the U.S., talk a little bit about what role the broker-dealer plays in transactions and why you see a role like a broker-dealer playing in this sort of more specialized space of conservation finance.
Yeah, absolutely. So, so if you think about investment bank, a traditional investment bank, they are helping companies. They do a variety of things, but one of the key areas of focus is helping companies raise capital. And so, there's a lot of companies out there looking for money. That's obvious. We all know that. We might have been part of a startup ourselves, and it just can be difficult to find the right connection points to get the capital you need at the appropriate time, to really get your deck and materials and financial model prepared for prime time. And so there's a lot of people kind of running around chasing, looking for money, who have great ideas but don't necessarily have the structure or process or network to really actualize the capital raise process. So broker dealers come into the equation and help, basically in some cases, set up the materials and the pitch deck and work on the financial models, and then also help a company through that capital raise process and making the right connections and going to bat for them. And the model is they get a success fee for those, the successful capital that comes into those companies. So when I say that this was missing, there's a lot of broker dealers out there, but not a lot that really know the impact space, who have developed relationships with impact investors. It's just not something that has been, I think, a priority yet, just given the nascent nature of the impact space. And especially with food and ag, it just hasn't been, it just hasn't emerged yet. So we saw an opportunity for our team.
Yeah, and maybe you can tell us a little bit about some of the early work of Provenance. I know it's a relatively new company, but any of the deals you can share with us, or any of the sort of examples of work you've done for businesses or for conservation groups that you want to talk a little bit about?
Yeah, absolutely. I have some slides here, so I'm just gonna
share the screen, or I know.
Yeah. So share screen. I'm a, oh, I've been made presenter. Okay, great. Can you all see my screen?
Yep.
Yes,
Okay.
we can.
Great. Well, I won't go through all of these, but I'm really excited about our model, and we iterated a bunch as startups tend to do, and kind of circled around a few different areas of focus. So, again, we're a financial services firm, but we're really aiming to build this marketplace to connect enterprises and funds in the food and ag space with appropriate investors. And so we provide kind of three main services: enterprise advisory, capital coordination, and investment advisory. We'll set aside investment advisory for now. It's kind of an area that we're exploring, but we're really focused on enterprise advisory and capital coordination, which basically means setting a company up to get ready for a capital raise and then helping them with their capital raise.
And just a question there, in terms of capital raise, you're talking about all forms of capital, whether it's debt or equity or any structure they may have?
Yeah, and we can get into that a little bit when we talk about some of the blended finance mechanisms, because we're really trying to we're trying to find appropriate forms of capital that align with the underlying ecological and social systems on which we depend and which companies depend. So instead of funneling companies in the direction of venture capital financing, which tends to accelerate their process or force them to grow quickly, that's not always bad, but it's not always the most appropriate form of capital for a given business, and the cash flows and the operational structure of a company. So we're trying to find and source appropriate forms of capital, which might end up being layered and blended depending on the situation. So this is something we're really hanging our hat on, is the ability to move within different forms of capital to really meet the needs of the enterprise and the desires of the investors as well. So I think just to lay out a more philosophical framework, you know, I'm sure you all have seen these gradations, but we really see regenerative investing as a step ahead of impact investing and really the next kind of frontier, because our thinking is that we really need to heal a lot of what's happened to our planet and our social systems before we can sustain them. So we're using the term regenerative in our work. And so again, just to kind of set the stage, enterprise advisory is really getting a company ready for their capital raise, and then maybe thinking about alternative business models, alternative forms of capital, and then actually going out and helping them raise the capital.
And that the sort of revenue model for you guys there is sort of more a consulting contract, and then if you get into actually raising the capital, then it becomes more of a success fee.
Absolutely.
A piece of capital raised.
Absolutely, and you know, one of the reasons, since we are working with earlier stage companies to date, we'd like to get into a later stage and kind of work with some of our clients through their capital raise process at different stages of the company's development. But with an earlier stage company, it's often challenging sometimes to pay some of the retainer fees. So if a group works with us on the enterprise advisory and then wants to do a capital raise, we can often roll some of that upfront cost into the success fee. And we also sometimes work with warrants as well, which are basically just, it's a form of potential equity in the company. So we kind of have three levers we can pull in terms of compensation. But the main thing that we thought was really instrumental for our business model is getting licensed so that we could actually get paid on success fees.
And just for people who are not as aware of the system in the US, basically you need a license from the SEC to be a broker dealer, and you need to pass certain training requirements before they let you officially do some of this work listed in private and publicly traded companies, correct?
Yeah, and I can talk a little bit more about that. So when we were getting started, we explored, so becoming your own broker dealer is a pretty onerous undertaking and requires a lot of compliance effort. So the SEC takes capital raising very seriously and selling securities very seriously. So everyone on the team, I mean, had varying degrees of experience with that and previous roles, but we had to decide if we wanted to become a broker dealer ourselves or get affiliated with one who would do more of the back end compliance work. So we affiliated ourselves with a group called Growth Capital Services. And so our licenses are with them, but we can raise capital through that entity.
And just a question, you also work with nonprofits, right? But that is more straight consulting contracts, or do you not work with nonprofits? Sorry.
Oh, we do. Yes, we do. So it's really interesting to understand like the role of nonprofits in some of this work. You know, if a nonprofit is getting a loan or a grant, there are cases where we can take a success fee on the loan or the grant as well. So we are excited to work with nonprofits in that capacity. And then in some cases, it makes sense for instance, I'll talk about an engagement we have with Savory Institute, but we're working with a nonprofit to explore a for-profit business model that could complement the work that they're doing and help it scale. So we absolutely work with nonprofits, and they're, obviously they're not raising equity, but there's some other forms of capital raising that we can participate in. So I just wanted to give a quick overview of some of our pipeline. We've got, namely we work with food and ag companies, but we're just seeing a lot of interest in the work that we're doing. So I thought it was kind of fun to just show a snapshot of in aggregate how much the companies we're looking at are currently raising. And so I just thought this was a neat thing to show. And this is what we get excited about, and seeing more capital. Like the very purpose of our existence is to kind of flow more capital to some of these impactful companies. And so as we're seeing more deal flow and more investors getting in and hopefully investing in these companies, we're having a direct impact on that flow of capital. And so I just want to highlight that we focus not only on the producer side of the equation, but really across the supply chain, and each step of the supply chain with the different companies we work with. So we're interested in working with processors, distributors, retailers, all along the supply chain, and we're trying to get more strategic about which companies we work with, where we see levers for impact and where we see potential for scale. So as we kind of evolve our processes, we're looking at different efforts to understand how companies perform different areas of the supply chain, where the impacts are, and really start targeting and honing in on companies where we think they have a greater chance of impact, and then focusing our efforts on working with them as clients.
And you've chosen sort of agriculture as the area of focus. Sorry, here it looks like I'm getting ahead of myself.
No, that's it, absolutely. And we just we've gotten a lot of feedback on our core competencies and what's kind of needed in the space, and so we just decided to focus in on food and agriculture because there's a lot there, and we're mostly U.S. focused at this moment.
Mm-hmm.
And we don't have a robust internal impact metrics system yet, but we see our company as having impact on all of these areas through the companies we work with. And so I won't read all of these, but all the things that we care about in the conservation finance field, we believe that by facilitating the flow of capital into more enterprises that do this work, we're having a bigger impact. And so this is the slide I wanted to share, just so I know we wanted to dive into a few case studies. So we've been working with, I'm sure many of you are familiar with the Savory Institute. They're sort of an iconic name in the regenerative agriculture community, and we were thrilled to land them as a client. In this case, we are working with a nonprofit organization, and our task was a situation assessment, which is really a deep dive into the operations and financials and kind of system of the business as it stands. It's sort of like an audit, but an audit to kind of prepare for a strategic next step. And so, they asked us to go through this process with them to then evaluate the merits of spinning off their land to market program, which is a flagship certification program that has been underway and it is well respected. And they wanted to potentially turn this into a for-profit business, certification business. So we went through and just finished that analysis, the first phase of it. So that's kind of one example. In terms of like conservation finance, I think this is a really interesting area because there's a lot of certification standards out there, and it's, I think we're in the early stages of certification and people trying to figure out, what are the real impacts? How do we measure? How do we determine whether something gets a premium? And so this land to market program is one kind of example of a pretty well-regarded certification standard. And so trying to think through like the business model in context with a bunch of different certification programs is an interesting exercise in kind of determining market signaling. And I personally didn't participate in this analysis, so I can't go too deep with it, but that is one example. I want to kind of pause, and I know I just said a lot, so.
Yeah. So, Savory has done a lot of work mostly on the ranching side and sort of more holistic ranching. And how do you raise beef in ways that are better for the environment, better for the soil, or not just beef, sheep, and other animals as well. I guess if I'm understanding correctly, the work there was really they had developed a certification mechanism. They had kind of tested it out, done some work of like what constitutes truly regenerative ranching, or is it just ranching, or is it beyond ranching to all forms of agriculture, more holistic agriculture?
I think
it doesn't matter, but something like that, right?
Yes, it's in that ballpark.
And then what you guys did was say, okay, here's a potential revenue side of the work of this nonprofit, this certification. You can maybe charge for it, make it more sustainable. And so you were brought in to think about how to build that as a more sustainable business operation. Is that kind of
like how do you take basically how do you build a financially sustainable certification model? Like if ranchers and others are opting in and wanting to get the certification, what are the ways you can monetize that and make a business out of it?
And so Savory's idea was sort of, let's spin this off into a for-profit business. And so you also help them presumably with sort of the building the business plan, financial models, as well as raising capital for this spinoff, or was it a different approach?
Well, right now it was just an assessment of whether this seemed like a viable opportunity. So we did the financial model and kind of came up with some recommendations and questions that needed to be answered to really decide to whether to move forward with this. But if we decide to move forward, it would be something we could help raise money for.
Great. Right. And then the slide also had a couple of other potential businesses. So you worked with a few businesses to raise capital and develop business plans and that sort of thing as well. And those are confidential. And then also on specific transactions, kind of analyzing specific transactions.
Yes, we have. I can't talk about one of them. Was a large organic farming management company that would buy upwards of 10,000 acres in the Midwest and transition them to organic, but their main competitive advantage was their actual pipeline of farmers that were willing to or had the know-how to actually make this organic transition. So this is an interesting cinch in the system, which is that a lot of people say, well, let's just, we have less than 1% of farmland in the US that's organic. Why, there's so much demand for this food. I go to Whole Foods, I see all this demand. Why don't we have more farmers who do this? Well, it's actually complex to transition the farm from a traditional farming mechanisms with a lot of fertilizer inputs and whatnot to an organic standard. It often takes 3 years. There's a lot of work you have to do on the infrastructure side. There's a lot of know-how on how to manage with less inputs, things like that. So there's not actually a lot of farmers who know how to do this well, especially on the large scale. So this group was really solving for that by helping train farmers and really developing that pipeline of farmers who could go get deployed on certain properties or who were really passionate about going and like transitioning a large parcel. So I just thought it was an interesting case study. It was like, the more you know, the more you realize why we are stuck in certain places and making transitions.
No, I think it's great to see a group like this, which is effectively a kind of investment bank analog with a specialization in kind of conservation finance and more specifically regenerative agriculture. Are you seeing many other groups like that? I mean, I know in a way Echo Asset Management Partners and Encourage, we do some of that work, though we don't have a broker dealer. We have considered, aligning ourselves also with broker dealers, but beyond Encourage and its predecessor, Echo Asset Management Partners, have you seen a lot of other entities kind of trying to fill that role of specialized investment banks or specialized broker dealers?
No, I think that's why we're seeing an opportunity for this model. I mean, there's groups called Big Path Capital who are definitely similar to us, but I think what they do is more broad. They don't just focus on food and agriculture. So, and I think some of the broker dealers we spoke to in deciding whether to align with them were very interested in ESG and impact, but don't have necessarily the expertise yet in their staff or their bankers. So yeah, in terms of like the broker dealer side of the sell side advisory, we have not seen a lot in the way of competition. I certainly think on the investment advisory side, there's a number of groups like Encourage and others that have kind of started, and even Creo and Tonic and some of these investor networks are filling the gap of like educating investors on some of these subjects. But like in terms of the transaction side of it and the sell side advisory, we haven't seen that many crop up.
You talk about sell side advisory. There are probably people on the line that are not familiar with that term. If you want to just kind of define it a little bit.
Yeah, absolutely. It's well, just think about the people with capital and the people that are trying to get capital. So often, the sell side is referred to as people who are trying to sell their whatever product or service to get money, and then the buy side are people who are, deploying that capital.
Right. So, advisors to people who are trying to raise capital versus advisors to people who are trying to place capital or invest capital.
Absolutely, yeah.
I know, I wonder if we could transition to some of the sort of newer, more innovative tools that you're looking at in terms of how do you use conservation finance, how do you use finance to push conservation to the next level. You and I have talked about a couple of different tools in the past, things like revenue-based loans or DAFs, donor-advised funds. Do you want to talk a little bit about some of those?
Yeah, I'd love to. So I just found out about impact DAFs. Well, I should say I heard about it at different points along the way the last 10 years or so, but I didn't really understand the potential of the instrument for blended finance, and I'll explain what I mean by that. But I'm just highlighting impact DAFs and revenue-based loans as two examples of ways that we're trying to use different mechanisms to help companies raise capital, and in referring back to my kind of opening comments about finding more appropriate forms of capital. So I just thought it would be kind of fun to dig into two instruments that I've learned more about recently, and I think have a lot of promise for the impact space and for conservation finance. So
yeah, you're probably going to do this, but yeah, there you go.
So I know this is kind of got a lot going on in this slide, but I thought it would be helpful to have a visual to kind of illustrate what a DAF is. So what I find, what a DAF is it's a giving vehicle. So its purpose is for deploying grant capital. So it's a way for an investor to say, I don't want to pay all my taxes this year to Uncle Sam. I'd love to have a tax advantage vehicle where I can get a tax benefit, but also give to the charities of my choice. And so these vehicles are administered by groups like RSF Social Finance and Impact Assets, manage DAFs for investors. So the money gets, go ahead.
Big Wall Street banks and money managers, I guess Fidelity or even Morgan Stanley or
Absolutely.
all of that.
Yes. Yeah, there's about 200 billion worth of DAF money out there in the market in the US, and most of it's managed by mainstream groups like Fidelity, et cetera. But there's a couple groups that do impact DAFs, which basically means that not only can you donate to the charity of your choice, but there are some, while the money is being held, it can be invested in different impact vehicles, and it's pretty flexible, meaning it can be invested in loans or equity. And so there's this dual purpose now where like mainstream DAFs aren't thinking about impact investing while the money's held, but impact DAFs are. So there's like kind of in many ways, like I wouldn't say double, it's not the right metric, but in some ways you're leveraging your grant money and having it put to work towards impactful projects while it's waiting to be deployed. So
to like give a sense of how these apps work. So let's say I'm an investor. I have a lot of money. I'm investing some, in traditional investments and Apple or whatever it is, and I have managers that help me manage that. But I also say to myself, well, I want to give some of my money away, but I don't really want to do it myself. I don't want to manage, all of the paperwork and the giving and all of that stuff. And traditionally, people with a lot of money would set up a foundation that's what they would do, right? That's what the foundations would do. So if you see the MacArthur Foundation or the Rockefeller Foundation, these were huge families that created these entities to give that money away. I think what's interesting is over the last decade or so, we've seen the emergence of these donor advised funds, which are essentially mini foundations, if you will, that Fidelity or Morgan Stanley or Impact or RSF or others create that say, you want to make charitable contributions, put it into this donor advised fund, which is essentially you will have a say in what charities it gives money to. We will manage the giving of the money, the keeping of the paperwork, and the giving you the tax benefit of putting your money in that fund. And as you were saying, now there are 200 billion of the assets in these types of donor advised funds. And while many of them are giving to all kinds of charities, depending on who's putting the money in, all of them are holding money before they actually make those charitable contributions. And how they hold that money, what they invest that money while they're holding in it is interesting because they could do all kinds of impact investments with that. Is that kind of what am I understanding what you're saying
yeah,
correctly?
that was very additive for sure. That was really helpful. And I think it is really important to add that, or to play off of that in that, foundations have this requirement of the 5% spend down per year to maintain their tax status, but donor advised funds in effect, and this can be one of the downsides of them, but if you put your money in, you get the tax advantage, but then you can decide when you deploy the grant money. So it's just a lot more flexible of an instrument from that perspective as well.
Yeah. And I think one of the criticisms of DAFs that I've seen is, in fact, that many of them have not deployed any of this charitable capital for many years, right? It's just kind of been sitting there without being given to charities. And they've gotten some of the tax benefits, but the money's just kind of sitting there, right?
Absolutely, yeah. And that's been one of the criticisms for sure. I can go into that a little bit at the end. But I wanted to share just like a few ways that it could be leveraged for conservation purposes. So I think loan guarantees is something that for a lot of early stage projects or complex conservation finance transactions, a lot of times we need groups who are willing to take more risk up front. And so DAFs can be an interesting source of first loss capital in these transactions. You can also pool money together for specific themes. So I was just working with a group, it was actually a panel discussion on trying to figure out how to scale this nonprofit model. It's a group that does wildlife conservation. And we were exploring the idea of using a DAF because the organization itself could get a loan for some of its operations and pay that back with different forms of revenue coming in. But for instance, a grant could be donated to conserve some of the land that they're looking to conserve for the wildlife. So it sort of like opens up some possibilities with deploying different types of capital for a particular project or enterprise. And so, yeah, here's Ricardo, you were highlighting some of the limitations You know, there's in some ways a lot of murky regulatory oversight. There's not a lot of rules around DAFs, which can be a good and a bad thing. And then, you know, you have some issues with, excuse me, you have some issues with, in many cases, the grants not ever getting deployed or just taking a very long time to get those deployed.
Yeah.
So yeah, that's DAFs in a nutshell. I know there's a lot here, but it's worth looking into, and you can research a little bit more on some of the ways DAFs are getting used through RSF and through impact assets.
Yeah, and I think it's something that many people don't know even exists. And as you said, it's getting bigger and bigger every year. And currently, you said there was a 200 billion in DAFs across the US.
That's a big number I remember from doing research. Yeah.
And you know, it's an opportunity from conservation, people interested in conservation and conservation finance, sort of from those two perspectives, right? Can we get them to make those charitable contributions to conservation projects and other things that can give them that tax benefit and get that money out? But secondly, as that money sits there and as it isn't invested or isn't given away, you know, can that money be used in ways, you know, traditionally what would they do? They would put it in a money market fund and or a bank account that makes, you know, 2% or maybe less these days on that money. Can we have them invested in a different way that both accomplishes the kind of objective and others? I think this is a real fertile area for people to think about, at least in the US. I imagine there's DAFs that give charitable contributions all over the world. So you could even look at it that way if you're doing a conservation project in Brazil or Uganda, right?
Yeah, I haven't explored as much on grant donations that go outside of the US, but I'm pretty sure you can.
As long as it's registered as some sort of 501c3.
501c3. I think that's the only real requirement is
tax exempt.
Yeah.
Awesome. Awesome.
Well, I know we want to get open it up to Q&A. Oh, go ahead.
You wanted to talk a little bit about revenue-based loans? We can take a few minutes there if you want.
Great.
And
yeah,
so put your, and I'm not seeing questions yet, so type your questions in so we can take a look at them, and we'll continue a little bit with revenue-based loans. Tell us about these.
Okay, great. So I love revenue-based loans. We've been exploring them for a few of our clients, and basically what's great about this instrument is it ties loan repayment to a percentage of revenue rather than just the kind of traditional cadence of a loan that's maybe monthly payments. And so it allows the investors to say, you know, I want a 2x return on my investment, but you can pay me back based on a percentage of revenue, and it'll take, you know, it might take longer, but it's more appropriately tied to your cash flows so that you can feel more comfortable servicing the loan. And so this is great for, you know, there's an instance that came up. There's a company that's grazing goats for brush management, for reducing wildfire, and for helping with wildfire mitigation. And there's this woman, it's called Shepherdess something, and she wanted to take on a revenue-based loan for her work, and a lot of her work is in the fall and spring, and so most of her revenue comes in kind of like 3 months increments. And so she felt that a revenue-based loan was more appropriate for her cash flow needs, which is absolutely true. And so it's an example of, you know, more seasonal type business models. A lot of the conservation work, you know, there might be prescribed fire groups or other groups that could take on loans, but they don't want to pay that, you know, cadence. They get hung up on the cadence of the loan repayment. So anyway, I just think it's an interesting model to explore. I know a few instances in which it's been deployed. Typically it's, you know, loan payback of like 5 to 8 years. There's interesting things you can do with paying back the interest and then turning the principal into equity into the company if you decide you want to do that and convert it. So there's also ways to kind of blend the investment. So it can start as a debt instrument and then end partially as an equity instrument as well.
So in this structure, if the company or the borrower has no revenues or goes out of business, does the debt get canceled as well? Or, is it basically a grant that if you don't, if you make revenues, you pay it back, or how is that structured?
Yeah,
Or is
I
it
mean,
still?
I think it if it's looking like the company is taking longer with revenues, there's always like renegotiating the terms with the borrower. I'm sure there's a few mitigating tactics you could take before completely just writing it off as a bad investment. But I think there's sort of intervention points. It's like first seeing if the percentage of the revenue needs to be decreased or the term needs to be increased, like the duration of the loan. Maybe you're comfortable with just some equity, translating some of the return into equity. But I think that you have, as a debt financier, you have kind of first loss rights to the equity holders. So obviously, if the company did go out of business, you'd likely get paid back before the equity investors. So you kind of have a little bit of more security there. But yeah, hopefully you're not tying yourself to a company that'll end prematurely. But
No, I think this is an interesting area that I think a lot of people don't pay enough attention to, which is most people are familiar with a traditional loan, which is I borrow money, I pay you back with interest. Either I pay you back, at a certain time, or else I pay you little bits and pieces over time, more like a mortgage or something like that. And then I think people also understand stocks and equity, and they go, okay, what is equity? It's an investment in a company. I'm part owner of the company. I can sell that and make money, the equity, or make money, or I can get dividends from the company. What's interesting about revenue-based loans and convertible loans that are converted to equity is that it's kind of like a hybrid, and it kind of straddles the space between debt and equity, in the sense that you can set up a loan where I borrow money and I either pay it back like a traditional loan, or it can be converted to stocks, or you can set up something like this revenue-based loan, where rather than paying back at a given time or in certain increments, it's all tied to when and whether I'm making money as a company. Have you seen revenue-based loans? You mentioned the shepherding company, other that might have used it. Have you seen it anywhere in sort of conservation groups or entities like that?
yeah, there's a farm that took on a revenue-based loan through Slow Money, Northern California. I think they organized the loan. And then there's another one, well, it's not necessarily a conservation group, but it's a food waste company that was considering a revenue-based loan. But I do know the farm in Northern California did take on the loan for a revenue-based loan, and I can send a little bit of information about that. And also an interview I did with Arno Hess, who's one of the founders of Slow Money Northern California. It's me interviewing him about revenue-based loans. And so I can send that as a follow-up.
Yeah, no, if you could, if you wouldn't mind, Logan, anything you want to put in the chat here.
Great.
I know that people may want to contact you either about provenance or any of these other issues. If you're comfortable sharing your email in the chat, that would be great. If not, we're going to send out recordings of this as well as your contact info if you're comfortable. But let's turn to any questions we have out there. I see that there's one question from, and I don't know if I'm pronouncing this right, Chaitanya Krishna. If we can unmute Chaitanya and let them ask their question.
Ricardo, I'm having a little technical difficulty with unmuting. Oh, okay, but there we go. Chaitanya, you should be able to go to ask your question now.
Yeah. Hi. Thank you, Ricardo. Thank you, Logan. That was really informative. I had one question. So you mentioned the food and ag portfolio that your firm has worked on. I was just wondering if you've worked on any fisheries related deals per se, and if you could talk about them if you have.
We have been approached by a few aquaculture companies, and it's something we're open to, but just in sort of the sort of slots we have available for Q1 next year, we're just currently working with some food enterprises. But yeah, it's definitely in the works. I have some expertise in fisheries and aquaculture from my time at Creo, so we're definitely excited about this space, and there's a lot of potential, but just haven't worked on a deal yet.
Okay.
There's
So
been some alternative
nothing.
approaches too.
Okay. So nothing on wild capture fisheries.
Not yet, no.
Okay. Okay, fine. Thanks.
I mean, I think some of these tools have been used in a variety of sort of fisheries and ocean side of things. You know, I know at Encourage we had set up a holding company to invest in fisheries management, fisheries processing. I know the Nature Conservancy has done a bunch of fisheries work, including some loan structures here in California around fisheries structures. But Chaitanya, if you want, I'm happy to send you the work we did with Oceana, Rare, Rockefeller, and Bloomberg foundations around investing in fisheries and wild caught fisheries. We took a look at what was out there at the time, and this was written maybe 5 years ago, so it's not the most recent. But there's a lot of increased interest, I think, in that as a sector for investment, and we've seen a couple of groups emerge, including the holding company we did, which was called Pescador, which now sits with the Walton Foundation, and they're making investments in fisheries and wild caught fisheries. I mean, maybe we can dig into, like, if you are a conservation organization interested in a project and think, oh, I need some help from a broker dealer like you were explaining, what is the process? Can anybody just reach out to you? What sort of work have you done in that space, or what's the process for somebody who either has a business idea, needs some help, or is part of a nonprofit that says, hey, I have a revenue opportunity that I'd like some help exploring?
Yeah, absolutely. Yeah, I think the easiest thing is just to have a quick conversation about it. So you're welcome to reach out to me. I believe all of our emails are on, or if they're not, on our website. It's just first name at provenancegroup.io for any of our team members, but you can reach out to me directly and we can talk more about the opportunity. But, you know, we typically are looking for companies that have some revenue. So I would say kind of pre-revenue, pre-seed are not really in our sweet spot. But, you know, companies that are seed, Series A, Series B, we start, you know, that starts to be where we're focused. And yeah, so it's just, let's chat and have a conversation about what your needs are.
Mm-hmm. Okay, we have another question from Mobolaji Idowu. Let's see if we can unmute you, Mobolaji, so you can ask your question. I think you should be unmuted. Are you there? Let me just throw it out there. It seems we may be having trouble connecting. It says, I would like to know, please, if DAFs are available to finance project outside of the US, and if so, what's the process? How does one, I guess, so how does one go about?
Thanks, Ricardo. I thought I muted myself before, but that's my question. Basically, you just asked it.
So I believe the only requirement is for the group to be a 501c3, and I do think you can do international grant making with DAFs, but I'm not 100% sure. I would say that the process, I haven't, from a grant making perspective, gone through that, but I think what happens is, if you explore RSF social finance or impact assets, there's usually a contact form, and I'm sure they accept kind of new projects and have their own process of determining how to get that information to investors. So I think it's just about reaching out to one of those groups. I don't know if my resources are getting sent to everyone, but I'm putting some stuff in the chat here.
Yeah, I'm seeing it in the chat. You have a couple of things on there. So check out the chat for both Logan's email as well as a few links to people that are in that space. I think what's interesting about donor advised funds is that the way they tend to work is that, generally speaking, the donor already has an idea of the sorts of things they want to finance, and they work with, Fidelity or RSF Social Finance or whoever they're working with to set up this DAF, to define that as, here are the areas, here are the organizations. I think when you get to the bigger ones, like the ones at Fidelity or what have you, they actually go through a process of analyzing the 501c3 that goes into the DAF or that they can lend to. And they have certain criteria that you have to meet in order to be eligible to receive finance. And then depending also on how it's structured, each donor, each investor in a DAF has a role to play in determining where that money goes. So it can be hard to actually, if you don't know anybody either in the donor side or at the DAF, to break into one of these and sort of say, hey, I'm doing an interesting project. But I think another way to approach this, if you know people who are making contributions or who could potentially make contributions, is to raise the idea that, here's an interesting way to channel that money to us through one of these donor advised funds at one of these entities. Because if they push it in the entity, so let's say they're already involved with a donor advised fund at Fidelity, if they push it within that donor advised fund, then your project or your organization becomes available to everybody else who's also in that donor advised fund. So it can be another way of reaching additional donors. But I have found that it's very hard to break into a DAF unless you know a donor or they know you already. But it is an interesting structure. I don't know if this sort of structure exists in, say, Europe or elsewhere. It's something I haven't really looked into, but I know it's very kind of a peculiarity of U.S. tax law that allows the creation of these sorts of entities here in the U.S. But even if you're in a country, another country, or in Europe, I mean, I think it's an interesting question of, should you push to get, donor advised funds created outside the U.S.? I mean, is this a structure that can work elsewhere? I think it probably could work in Europe if it doesn't already exist in some way, shape, or form. I think it's probably different, more difficult, or maybe not in, Brazil or Colombia or South Africa or somewhere else.
Yeah, it's a great area for exploration. I haven't looked much outside of the US either, but I think those are great questions, and it might turn out to be, in certain countries, a really good instrument to expand the capital base for conservation work.
Did you have a follow-up, Mobilize? Maybe we lost them.
No, I just wanted to say thank you.
Awesome, thanks for participating. So I'm not seeing any other questions. So maybe we can talk a little bit more about kind of where you see Provenance Group going in the future, and where you'd like it to get to, and what the future looks like for an entity like this.
Yeah, absolutely. I mean, mobilizing more capital towards food and ag enterprises, seeing them grow. We don't want this to just be a transactional banking model. We really want to help see companies through multiple stages of their capital raise and have a long-term trusted partnership along the way. So I think finding a few key groups we can work with, continue to grow that out, doing as much as we can in the US to advance regenerative agriculture, and then continuing to think about different instruments to drive more capital. We're considering special purpose vehicles for certain enterprises and assets that are interesting to share with investors, and syndicate around, meaning bringing multiple investors into a particular enterprise or asset through like a special purpose vehicle. So we're kind of thinking about different ways to bring in those resources, and then potentially down the line.
On that, I think it's worth pointing out for people who are not in the investment world what a special purpose vehicle is and how it works. I think, I'll just say that essentially in many of the business worlds, when you want to do a project or some investment structure, but you don't have a company to do it through, or don't want to do it through your existing company, you can set up a company whose only role is to do something specific, whether it's invest money in a project, undertake a project, raise capital, what have you, and you set up a company whose sole purpose is that special purpose, right? And those are called special purpose vehicles, and it's a whole area of corporate finance and corporate law of how you actually create these special purpose vehicles to do that, and to raise money. But it's an interesting structure that, again, people who are not in the finance world don't know is even an option, and yet it's been used by many corporations to do all kinds of different things, and could be used by nonprofits or conservation companies to do even bigger and better things, right? Yeah,
absolutely. And I think in some cases, raising a fund is its own large endeavor, and it has its merits, but in some cases there might be
about it. Far too many.
Yeah, there might be a company or a particular asset that you want to raise capital around and not go through the process of launching a fund to manage the asset. So it's just kind of a more straightforward, seemingly approach to in some specific cases. So that's something we're exploring.
Do you see? Sorry, I was just going to ask you. Do you see forward the possibility that sort of the more traditional investment banks will become your competitors? With Morgan Stanley and Goldman Sachs and JP Morgan all have sort of sustainability divisions in addition to their standard investment practices. Goldman has bought an impact investment firm, and so that's become internal. Do you see them competing with you down the line, or are they already, or how do you manage that?
Well, I think right now our deals, I think, are too small for the interests of most of the large players. I think it's an emerging area. Regenerative agriculture is even more kind of difficult to understand and less evolved in terms of like metrics and whatnot as sustainable agriculture and the rest of the impact investing space. So I think we're kind of hitting the early phases of this. So I think by the time hopefully we're underway, we will be a stronghold, and if anything were to evolve in the future, it might be an acquisition of some kind by a group like that if we were to entertain that. But I would assume that a big bank or a big group or a larger broker dealer would be more interested in acquiring a group like us than trying to build out the expertise to compete.
All right.
That's my take on it.
Okay. Who are the big players right now who you see are kind of like closest to doing stuff like that?
Which groups?
Yeah. Who would you say are your major competitors?
I think there's a few broker dealers we've interacted with that have some impact bankers on staff that we explored while we were deciding who to go with for our affiliate broker dealership. So yeah, I would cite like a group like Terragenesis or Growth Capital Services, or groups that are sort of starting to see the value of impact investing. Big Path Capital are probably our main competitors. In some cases, it's also just individual bankers. It's individual brokers who just really know the space and could do a number of transactions, you know, because again, the space is still pretty small. I think there's just, but there's still like room to just be one expert.
Yeah. So I just noticed that Brian Brandt has their hand raised. I don't know if that is a mistake, or did you have a question, Brian? I'll unmute you. Nah, maybe not. Maybe, I don't know why they raised their hand. Okay. Well, cool. Logan, anything else you want to leave people with? Any other issues you want to raise or dig deeper into anything?
No, I mean, I think we covered a lot, and I think there's some exciting areas to explore further. I don't know what all of you are working on, but I do think in many cases there are alternative forms of financing or ways to think about raising capital that are deviating from the norm. And so groups like ours can kind of help educate you on some of those topics. And, you know, we started a little bit today with DAFs and revenue-based loans, but just think a little bit before you launch your project or go to the next phase with it about some of these alternative forms of financing. That's kind of my message.
Right. Yeah, I know. I think I see it as a fascinating next step in the evolution of sort of bringing together the worlds of finance and the worlds of conservation to actually have broker dealers with expertise in both these areas, in sort of investing and finance, and how do you build a business, and how do you help support entrepreneurs on the one hand, and on the other hand in kind of conservation or even a specific area like regenerative agriculture. I think that can only lead to really cool, bigger and better things. So appreciate your work on that. Oh, I'm getting a chat from Brian. It looks like he does actually have a question. And he says he wasn't able to unmute. Let me see if I can unmute him again. Try.
Now, can you hear me?
Looks like you're unmuted, Brian. Yep, we can hear you.
Okay, I actually probably have two questions here. So the first question is, you know, I guess I'm wondering how you evaluate outcomes. I imagine economic outcomes are fairly straightforward, but how do you vet and evaluate, you know, social outcomes, environmental outcomes, you know, related to investments in this? And maybe a second part of that question is, how do you evaluate the equitability of market opportunities? So in other words, I'm kind of in the world of water quality and potentially working with farmers to generate environmental outcomes, and I think they're the least knowledgeable about these types of opportunities. So, you know, in what I'm trying to do, trying to create a framework where maybe they're a little bit protected and kind of bring them up to speed on knowledge of these opportunities. So how do you evaluate also the equitability of different market options that you might recommend as an investment vehicle?
Thank you for that multifaceted question. Trying to think how to maybe start. So on the impact measurement side, there are a number of different efforts by various groups to come up with impact metrics across industries and across different company stages. So I think like a lot's happening right now. It's almost hard to keep up with, but what we're trying to do is we have I didn't go into this, but we are mapping the landscape of food and agriculture companies to the best of our ability with PitchBook and some of the other tools out there, and coming up with like risk and return metrics and trying to track those over time. And in our efforts to do that, we're classifying impact metrics by subset of the food and agriculture space across the supply chain to try to understand which metrics are most appropriate for which type of company. So that's just something we're working on. I don't, I could go into some of the details.
Can you give examples of the types of metrics that are included in that?
Yeah, so I think it's helpful to think about how far you are from the ground. So, it might be a little easier to measure what's happening on a farm rather than looking at something like a company that's farther downstream from the supply chain. So we're trying to figure out our approach to how we're actually measuring the on the ground impacts, recognizing that companies that are more on the tech side may not be as directly connected to what's happening on the ground. So we're trying to develop like a core set of, regenerative agriculture practices that will have the outcomes that we want, like soil organic matter increase, reduced fertilizer and inputs, things like that. So there's some practices, and then measuring kind of the outcomes of what's happening on the ground as you transition to a regenerative farming method. And then from there, kind of determining how a company is related and how far they are away from those impacts. That's sort of sounds philosophical in nature, but there's also like regenerative agriculture principles of a business, like transparency and good governance and other elements of impact that are related to how the intent of the company. Like, I think there's some critical things there that we are also developing an impact measurement scoring process that as we review a company and decide whether we want to work with them, we're thinking about the team's vision, how connected they are in the space, how well staffed they are they leading towards burnout, are they transparent with the rest of the team in governance matters. So I think there's like some core elements there that in addition to the on the ground actual like regenerative agriculture practices are critical to this whole regenerative conversation. So it's kind of
yeah, go ahead.
No, it's a difficult challenge to try to measure all these things, but I think thinking about it as like just as you would with certain farming practices are likely going to lead to the outcomes you want, certain governance practices, certain team management practices are likely going to lead to the outcomes you want. So in some ways it's like a keystone metric. It's like you can't measure everything, but what are the indicators that are likely going to lead to regenerative outcomes? And so that's what we're working to.
One interesting question and inherent in what Brian was asking was, how do you protect farmers and others who are perhaps not as savvy about the financial instruments from, at least the way I heard it, and Brian, you'll correct me if I'm wrong, but from being taken advantage of through these metrics, or how do you make sure that these approaches are equitable in some way, shape, or form? Is that sort of where you were going, Brian?
Yeah, I think the question is how do you provision the economic benefit? Could the farmer be getting the short end of the stick because they're not as knowledgeable and don't understand what their benefit is valued at? So I think you're kind of getting to the meat of what I was asking, Ricardo.
So are you kind of speaking to instances where there might be a business model that's reliant on farmers, but not and working with them, but not a farming enterprise, and you're just?
Well, I definitely believe there's middlemen, I guess, the go between, and a farmer is focused on primarily focused on producing grain or whatever their output they're producing. So to be able to to participate in whatever market they're thinking about, they have to rely on others, another intermediary to participate in that market. like I said, they may not be knowledgeable about the value of what their outcomes that they're producing are, and maybe given kind of a take it or leave it kind of sales job, I guess. So I don't know if that totally answers your question, but that's kind of what I see potentially occurring or taking place in these markets or these opportunities that farmers can participate in.
Well, I think I would answer that in a couple ways, and the first is the principles of a regenerative economy or regenerative business. Like we were saying before, transparency, good governance. There's actually 8 of these principles that were outlined by the Capital Institute. There's a regenerative manifesto that John Fullerton wrote a number of years ago, and I actually drew these 8 principles from his work. But I think foundationally, when we're deciding personally to work with an enterprise, we're going to start asking questions to try to get at the intent of what their business model is about, what their goals are, how they're measuring impact, how their relationships with suppliers look, and things like that. So I think that it kind of starts with a conversation with the team to better understand how they're thinking. And I think as you get, if you ask the right questions, you can start seeing whether they're trying to take advantage of farmers or whether they're not being clear in their pricing, or they're not being fully transparent about their offering or something like that. So one group that comes to mind is a marketplace that aggregates farmers in New York City and has a direct-to-consumer business where they do, it's called Farm to People. And if I were to work with that company, I would want to better understand how they work with farmers and what their supplier model looks like, what their contracts look like. Do they have aggressive terms? You look at comparables with other groups that are doing something similar to try to just assess what's fair and appropriate. So I don't know. I mean, that's just one approach to answering your question, but
maybe the way to think about it is less about the work you do, because the work you do, you have these regenerative principles so ingrained into everything you're doing that you're kind of looking out to deal in transactions and businesses where that is not happening. But how do we, as we try and bring, say farmers or conservation organizations together with the world of finance, what are the sort of safeguards? How do we ensure that they're not taken advantage of, or that they get their fair share of whatever return is created from these types of businesses? I think that's kind of the intent that I hear in the question that Brian is asking, is like, well, where are the safeguards? How do we make sure as a society that these things are distributed fairly, or the benefits are distributed fairly, and that it's not just middlemen and Wall Street firms taking most of the fat off of the transaction?
Yeah, and your answer was helpful. I wasn't aware of the 8 principles you talked about, and that's something that I can look into in my projects. But I appreciate the answer.
Yeah, well, it's a good question. It's a complicated answer, but I was also thinking there's ways to embed different contract terms. I think cooperative business models is something else that we're looking into as in terms of alternative business models, as a way to bring more equity and distribution of wealth within a company. So there's a lot of cooperative structures are used in Europe, actually, and like you'd think there'd be more here, but there are a number of ways that cooperatives can be leveraged. Like there can be producer cooperatives, there can be individual entities that become cooperatives, and it allows employee ownership of the business. And so that's just one way to kind of redistribute some of the top heavy nature of some of the enterprises. And so I don't know, that's just another area to kind of, it's been fruitful discussion for some of the equity issues that have arisen recently.
Yeah, and I think it's interesting because, this brings us to the question of the role of companies and corporations, and, do they just serve shareholders, or is it a broader side of serving stakeholders? And this whole concept of, I don't know if you're familiar with it, Brian, but stakeholder capitalism, and a lot of groups that are thinking of, what does a better business truly look like? And you have movements like the B Corporation and other things like that are trying to redefine some of this in terms of like, well, what is the fundamental role of business in all of this, and can they help not just their shareholders but also society and other stakeholders, whether they're customers or providers or others? And I mean, we are a B Corporation and have been for a long time, and some interesting angles there. And bigger firms, even I think Danone is a B Corporation. So some of the big firms are starting to move in that direction, and I think it may be pointing towards a new evolution, not just for traditional firms, but maybe even for investment firms going forward. And maybe that's something that we can explore in the future. Case study in conservation is this whole movement towards what constitutes a new business and business structure. We're quickly running out of time. Thanks, Brian. Good question. I think there's going to be a lot of work answering this question of equitability in finance going forward. Appreciate it. But also wanted to thank Logan for taking the time to talk to us about provenance, about DAFs and revenue-based loans and other future approaches. I would encourage people who are interested in this, she's put her email in the chat, contact her or reach out to me. I'm happy to have these conversations on an ongoing basis. So really appreciate that. And also don't forget to send us any thoughts you have on future case studies in conservation. We're still trying to decide whether this is worthwhile, whether people get value out of it. So do let us know if you think this is working or not working, or if you would like to see in 2021 more of these types of conversations. But really interesting, Logan. Thanks so much. It's great to see a new broker dealer with this out there, with the approach out there. So appreciate that, and maybe there's a couple of deals we can talk about and figure out how do we work together with you.
Thanks so much for having me.
Awesome, and thanks to Kinship for making it possible. And we'll see you maybe next month in the next in this series of case studies in conservation.
Sounds great. And like I said, please feel free to reach out to me with any questions, or happy to chat.
Awesome. Thanks so much.
Take care. Bye.